it created that little tiny institutional order flow entry drill. So in your notes, whenever there's a fair value gap like that, that low, all it takes is trading one tick below that. And that when it does that, that's an institutional order flow entry drill. How would you use institutional order flow entry drill as an entry? Well, when you anticipate a gap staying open, but you think it may trade higher, in this case, trading up to this area here. So I drew all this out here, and I told you that I want to see this stay open. I don't want to see it do that, like come down and completely lay over top of that lower level line. I want to see, it can come down into it a little bit, like it does here, maybe even trade down to the halfway point, which is consequent encroachment, but I don't want to see it trade all the way down into it. But there are times where I want to see it close in because I want to see it fail. And that's something for your notes too. The inefficiencies that stay open are going to act like real support or resistance because this is acting as a breakaway gap. How do you know that that fair value gap doesn't or won't likely close in? Like what gives you that discernment? What makes you say that you can trust that? Well, we've consolidated like this here, and my attention was around this level here. Not enough to take a trade, but I wanted to see, does it repel this and start to break down? Before I go any further on that, if it would have started to break down, I would have dropped down into a 15-second chart, used the fair value gap, and outlined that down into the level I was looking for over here and then here. But it didn't give me that retrace back to it and break down because we're looking at it on a 1-minute chart. Then I could drop down to a 15-second chart and then use that and teach on the price delivery continuum theory. But why did I talk about this staying open before going up into this area here? Because we've traded above the consolidation, all of this right here, all this price action here. We've traded higher since 9:30 here, up, back down, trade higher, consolidating, okay? I don't like these kind of days, and I would rather wait for more information or do nothing. Because on a day that's showing me that it's not trying to gyrate around too much, it's small and compressed. Whereas when it does finally move here, outside of that range, we had the stops below here taken out, as I mentioned, and then we traded above the high. Okay, wonderful. Once it does that, that means we left this consolidation. Did we leave the consolidation after a stop hunt? Yes. So that means once we're outside of this range, and if we have a fair value gap, those tend to be left open. If it's something like this, then you anticipate them staying open, and you have a target up here that you think is going to draw a price to, you can put this candlestick's low, your limit order, right at that candlestick's low. Because then it only takes one tick to get below it to fill you long and then aim for your target. But when it's open like this, you can use institutional order flow entry drills, which is a partial entry into a fair value gap that you believe strongly is not likely to completely fill in. Now, you will see these setups form, and you will enter with institutional order flow entry drill as your entry model, just like any other model, any other entry technique, okay? But it's a very specific element of anticipating fair value gaps that you believe will not close up or fill in like in here. That's it. And we waited until 10:52, which is inside the macro for 11 o'clock, 10:50 to 11:10. There's going to be a run on liquidity or a run to inefficiency. But anytime I say a fair value gap that or an imbalance should stay open, what I'm saying is this is for your notes. If it's something that's acting as a premium array, meaning that it's trading up to it, which is the opposite of this, because we traded up and we're trading back down into it. The most sensitive area in that fair value gap is going to be the midpoint to the high of it here, which is this candle's low. So even if it did trade down into it, if I'm wrong about it not staying completely open and it trades down to the low, it matters not because I'm going to get filled either at that candle's low or just above the consequent encroachment or midpoint between the candle's high here and the candle's low, so halfway in between. My fill will always be in that area. I am never trying to get a fill at the low end because I've seen many times that the market won't go down there, or if it goes down there, it won't fill me because of the spread. So I'm not trying to frustrate myself, but your stop has to be below this candle's high. The best fills are going to occur at the midpoint, which is consequent encroachment, to the high of that gap. And the least probable fill is going to be in the lower half because you're probably not going to get filled. Why? Because this gap formed after leaving this consolidation. So therefore, this gap should behave. It should behave as a breakaway gap. It's breaking away from this consolidation. If I'm building a position and say this gap is larger, okay, say it's a little bit wider, I will use institutional order flow entry drill as my first entry, 6 contracts long, and it may dig down into consequent encroachment or the upper quadrant, and then I'll add 4 more. And then if I really like what it's doing in there, or if we enter in between, like say it like this, say it goes in at 1047, say this time was 1047, and then at 1049 it went down into consequent encroachment, and then at 1051 it trades down into one tick below consequent encroachment. I'll add 5 contracts on that one, even though I'm underwater a little bit on the 6 contracts and underwater maybe a tick or two on the trade that I added 4 on. That would be 10 contracts. Then I can go in with a 5 lot when it goes to one tick below consequent encroachment. If this is not your cup of tea and you can't see that, okay, then you would be trading order blocks, okay, and that would be this candle right there, and that candle right there, and that candle right there, because all 3 of these candles are all one order block. These 3 consecutive candles are trading back down into this gap that has already been primed to send price higher, and we're just getting one more visit here, and then it trades above it, and it comes right back down and digs into this entire range here. See that? So if you look at it like this open price, all part of these consecutive candles, okay, that open price is the change in the state of delivery. That means the algorithm sees these 3 candles and goes right to that opening price. What makes these 3 candles the order block is because we have a fair value gap down here. The momentum is shifted higher. This should stay open, trades down and touches the top of it, and starts to move higher away from it. It does so, okay? When this candle's open price, when that is breached, that validates this order block. Now, look at that opening price through all of this back and forth price action. See that? You want to extend that to the right and then study how price respects and deals with it. The wicks are always allowed to do the damage, but look what the bodies are doing. The bodies are staying in the upper half of the bodies. The bodies tell you the narrative, okay? So if you take that range, we have the body on the open down to this close on the lowest down close candle. That range, okay, that range is where the narrative is going to be seen. You're gonna see what, if this is an order block, these things I'm going to show you right here, they're going to be present, okay? Extend that forward. The body stops right there at that open. But what does the wick do? Trades down. This candle's up close. It doesn't matter. It doesn't mean anything. This candle trades down into the open plus a tick or 2 and then trades higher. Then we trade down again. What is it doing? It sends the body into the upper half between that candle's open and this candle's close. That red line. Look at what's going on there. Where are the bodies of the candles? Any down move back into that range, where are the bodies? They're in the upper half. You can see all the bodies are working inside that, but the wicks are allowed to do the damage, but they're never piercing the body's low. See that? And then over here, what time is that? Oh, it's so fucking good, isn't it? Isn't that delicious? Look at that. 11:10. What do you think's happening right there? It opens, it sends the price down into that opening price right there. So here is the first trade in delivery inside of the fair value gap. This is the PD array. At 1050, the algorithm will do what? It will seek inefficiency or liquidity. Okay, well, we have a gap. It could act as a breakaway gap. We expect it to trade down into it, but not fill the gap in. Wonderful. What time is that actually occurring? At 1052. Does it meet the criteria for a macro? Yes. So the time this is forming, it meets it. So that means the market should start to gravitate where? To liquidity, here, and where I took you to the daily chart. Because if the market's going to move, it's going to move to something on the daily chart. It's not just 1 minute charts. There's got to be some kind of higher time frame premise. Then if you build that in relationship to what you see on the smaller time frames, you have the best of both worlds. But the inefficiencies on the daily chart, or the stops or liquidity that's being either engineered or engaged, traded to, booked to on the daily chart, all of the things that make the world go round in the financial market, the key premise and levels are going to derive from the daily chart. It's the previous day's high and low, the previous day's high and low in the last 3 days, last week's high and low, the upper quadrant, the midpoint, and the lower quadrant of that range. Those are always the levels that you need to have. But here's the 1050 to 1110 macro. The market will spool. That means it jumps and runs to one of 2 things. It will go to a short-term low to tap into liquidity, that it would be sell stops or sell side liquidity, or it goes up to a short-term high, which is buy side liquidity, or engage buy stops for the purpose of introducing liquidity to the marketplace, or it trades to an inefficiency to invite smart money to capitalize on an entry right before price spools to the liquidity. But it's occurring at 1052. It's trading in that inefficiency. For what reason? It's going down there to offer fair value for anyone that understands the elements that I'm teaching you. Then where does the market trade to? Liquidity, which is that high here, because when it drops down here, the highest high prior to that is here. But what's above that? That volume imbalance. So at 1052, we're trading inside the time. That means every hour a macro is in operation. Every single hour. Some macros are better than others. I'll leave that for the book. But at 1050, for the hour at 11 o'clock, 10 minutes before 11, and 10 minutes after 11, that's a 20-minute interval, okay? What occurs is the market will seek either inefficiency, like this gap here, or it will seek liquidity. If it's, like, say for instance, we didn't have this gap here, okay? Say this wick touched this wick, or the bodies touched. There was no separation between, and not having this one singular candle traversing between the previous candle's high, and the next candle's low. So there's no gap, basically what I'm saying. If that's the case, then what you would do is you would wait for the down close candle that forms in any retracement here. It has to run away from it and then come back down, like we're teaching this order block. That would be what you would look for. But if there's no inefficiency, you have to use the order block. So either it's a gap or an order block or a short-term low. So there is no short-term low in here until that forms. But what's there? The inefficiency. So there's no condition that has all three. You know what I'm saying? Like, you're not going to get a short-term low, an order block, and a fair value gap. That can't occupy the same space in the time frame or chart you're looking at. It's physically impossible. It doesn't work that way. They can't all three agree and exist in the same place, not at the same price and same time. It doesn't work that way. It's two at best, but never all three. But usually it's one or the other. Okay, at least one of the three. So there's no short-term low to be worried about trading down below. We do have a gap, but it happens to form after a breakaway from all the consolidation that we were monitoring and I was not interested in all morning here. This gap forms after that breakaway from that consolidation, which is classic. So at 1052, we have our first piece of information. Yes, price did trade down in there. Yes, it did not fill that lower portion. And any subsequent touch of the fair value gap high can be used as support. It should be immediate response, take off and leave it, and trade to that high. But how far above that high can it go? You got to go to a higher time frame reference point, which is why I took you to the daily chart to highlight this volume imbalance. It was the easiest, obvious level above this high that's inefficient. So from entering here at 1052 into this fair value gap, you have all the way up to 1110 to see any new entry. So all through this period from here to here, relative to time, okay? This is a time window. In other words, this is what you're saying. In price action, there's going to be opportunities to be a buyer at a discount array. What discount arrays do you see? Institutional order flow entry drill inside this fair value gap that should not fill in because it's a breakaway gap. Why? Because it left the consolidation. Okay. Then we have this down close candle. Does it repel price after? It does. Does it trade above the opening price? Yes. That validates this down close candle as an order block. Is there any down close candles prior to that candle? Immediately to the left of it? Yes. Is there one prior to that one? Yes. Is there one prior to that one? No. So algorithmically, the price is called to that opening price because it's the highest portion of these three consecutive down close candles, the opening. That's the price. That's the change in the state of delivery. You extend that through time. How far do you do it? All the way till 1110. Trades right back down into that opening price. Bang. Then it delivers higher. If you're trying to get on board and you're trying to work with a macro, because a macro, that 20-minute interval is like a supercharger for efficiency and immediate responsiveness in your entries. If you focus on these elements of your setups, you're going to get the better fills. You're going to get the immediate response by price telling you, yes, you're on side. How do you know you're on side? When the market immediately starts moving away from your entry and never getting close to your stop. That's a wonderful feeling. How do you get into trades that promote that as a steady diet? Time. But the point is you have the down close candle here. Is there a down close candle prior to that one to the left? Yes. And it does it here? Yes. And then you don't have it here. So you use the opening price there. That's all their algorithm's doing. That's the code. That's what it does. By time, it does this. Okay, it touched here. Why? Why is that important? Because this is the framework that causes that inefficiency. Right here, I'm sorry, right here at 1050, that's the beginning of the macro. So what occurred right there at 1050? We've already taken out relative equal highs. So we are engaging liquidity. What kind of liquidity? Buy side. So what is the more likelihood of price going higher at that moment or going lower? Well, we have the short-term low that it forms and then trades higher once more. So we have buy side once more. The inefficiency below the marketplace is where? It doesn't exist in here. All this run up to that high, there's no gap there. All of it's laying over top of each other. This wick here goes back to this low. So there's no inefficiency there for the 1 minute chart. So what does it mean? Sell side if it's going to go discount to here, and or what's that daily inefficiency that's in yellow? That volume imbalance. We went down to it here, we rallied back up, traded down, one more higher high, and then digs all the way back down. What time? 12 o'clock. So that's mid macro. It's like the first 10 minutes entering the last half an hour or last half of that 20-minute period. So if it's going to be reacting off of that, and if price is bullish, where would it go to at that moment? The price will spool where? To a inefficiency above that. So where's that at? Not here. It's basically overlapping there. You have this one, which is a volume imbalance, which is a smaller form of what this shaded area is that's derived from the daily chart. So you can trade up to that. It does that handsomely. It does this one here again handsomely. And you have all of this here. It trades up to that there. And then you have the liquidity above that high. So price is doing what? It's using this time to refer to key price points. And if you are looking for a directional run, it helps you frame that. Every single hour it does this. Look at the difference between, like, see how we have 1150 to 1210 here? I'm going to do the same thing for the 1110 to 1050. Okay, so in between these two vertical lines here, the purest, cleanest delivery, how price will spool. Look at the difference between 1050 and 1110. The real runs start in there, and then after 1050, price can still advance, but look how shitty it gets. All of this, all of this, all of this, all of this, and then suddenly what happens? The algorithm starts going back into what it does, following its code. At 1050, 10 minutes to 12, we get run on liquidity, back down into a discount, sell side, run. Can you see that?